Hey, it's Arion with investingarchitect.com. And in today's video, I'm going to walk you through how investment pros look at investment property metrics to make sound purchasing decisions. So a few weeks back, I posted a walkthrough video on YouTube on the exact analysis process that we use to analyze a property from start to finish. And one of the questions that I got in the comments said, well, this is all fine and good that we can calculate these numbers, but how do we actually use these metrics to make good decisions? And I thought that was a great question. So I thought I'd shoot a quick video to walk you through how we do that in our business. So I'm going to share my screen here with you and we can dive right in. All right, so what we have here is our property investment property analysis spreadsheet, which is a basic profit and loss statement for the property for a year. So here we've got our rental income, our vacancy provisions, our operating expenses, so your property taxes, your insurance, homeowner association, property management, leasing fees, and so on. And here at the bottom, we have actually calculated the metrics on this property, which are your net operating income, which is the income the property produces when there's no mortgage. We've got the annual positive cash flow, hopefully positive. We've got the capitalization rate or the cap rate over here, the internal rate of return, and the cash on cash return, right? So now that we've calculated these, how do we use these metrics to make good decisions? Which ones should we use? Which one is better than the others? So in order to answer that question, the very first thing that we need to look at is uh, the 5 different ways that a real estate investment provides returns for its investor. And the 5 main ways are equity capture, which is the difference between the market value of the property and the purchase price at the time of purchase. And again, if you paid market value for the property, then there is no equity capture at that point. But this is one of the ways that an investment property can provide returns. The second way, and the one that's most people are familiar with, is positive cash flow, which is the net return that a property produces in a year after all expenses and mortgage payments are paid out. And then we have the debt paid out, which is the amount of principal paid towards the investor mortgage every month. So essentially, as the tenant's making their rent payments, part of that rent payment goes to pay your mortgage, and part of that mortgage goes towards principal, and that builds the investor's net worth. Then we have appreciation, which is the increase in property value over time. And then we have depreciation, which is a tax deduction on investment properties that essentially reduces the effective tax rate that the investor pays on the cash flow or the profits from the property. So it's essentially a tax benefit. So in order to answer the question which metric we should use to make good purchasing decisions, we have to then conclude that the measure that best captures these 5 different types of returns and the measure that best reflects these 5 different returns would be the best one to use. So let's look at the top 3 metrics that most investors use. The first one, the easiest one, the most common one that's especially preferred by newer investors, is the cash on cash return. And the reason why new investors like to use this one is because it's easy to calculate, it's sort of simple, and it's quick, right? So it's great for rule of thumb decisions, and it essentially reflects the cash in versus cash out, meaning how much positive yearly cash flow does the property produce over how much cash did the investor have to put in, including down payment, closing costs, make ready, and so on. So while it's easy to calculate, it has several problems with it. The first one is that it's a very static measure. And by static, I mean it only reflects what that property is going to do in year 1. So you could have an investment property where it works really well and it produces a great cash on cash return on year 1, but in years 2 and 3, the cash on cash return may be horrible because you've got, for example, capital expenses like roofs to replace or air conditioning units that you didn't really account for. So you bought the property based on a really positive cash on cash return on year one, but you didn't account for what happened in years 2 or 3 or 4. The second thing is that it's a snapshot, so it doesn't really reflect the sort of the production of the property, or the way that the property is working for you over time, and it doesn't take into consideration. It doesn't reflect your equity capture. It doesn't reflect the debt pay down. It doesn't reflect any property appreciation or property depreciation. So it's a very sort of cash flow centric measure. And you could see a scenario where you could have a property that has really good equity, meaning you could capture a bunch of equity on the purchase, but for whatever reason, the price to rent ratio is such that the property doesn't produce a very good cash on cash return. So you could have really good equity capture, really good property appreciation rates, but because of the lower cash on cash return, you could pass on a property that overall could provide really solid returns. So it's simple, it's easy. You should probably calculate it, but making purchasing decisions on cash returns is short sighted because it's a very static snapshot type of metric. The second metric that I want to go over is a capitalization rate, which is essentially the net operating income, the income that the property produces after all operating expenses, but before the mortgage payments, divided by the property price. And this is more of a yield type metric. It at the very core, it reflects what the property would produce if you paid cash for it. What's the yield rate that it would produce? And it's a very useful metric in commercial real estate, because in commercial real estate, they use it to come up with the value of your property. Um, so if you're buying commercial investments, this is a very good metric to use. If you're buying residential, you could calculate it, but it's not really telling you much outside of, again, what the yield is if you paid cash for the property. So this is, we have plenty of clients that when they purchase commercial investments, they have sort of a target cap rate that they go after. Usually it's somewhere between 7.5% and 8% and up from there. That's sort of the minimum threshold. So if you're looking to purchase commercial investments, this is certainly a metric to keep in mind. And finally, the most comprehensive, in my opinion, of all metrics is the internal rate of return. And this metric looks at a property in a timeline. It looks at it as a series of cash flows from year zero, which is the year of purchase. So in this case, we've reflected a negative 40,000, meaning a negative $40,000 investment that goes into the property because it's going away from the investor and into the property. Then we've got in years 1 and 2, we've got the positive cash flow coming back. And then in year 3, it assumes a sale. So it looks at this stream of cash flow and it comes up with an annual return that reflects the sort of the return on the property for the duration of the investment. And it's a great measure because it reflects the return of capital, the capital coming back to you, which accounts very well for the equity capture that you got in the very beginning, and accounts well for the debt pay down as the loan balance goes down, and it accounts really well for the appreciation, the actual appreciation rate that happened on the property. So it's a more encompassing, comprehensive metric, and it's the one that we use in our business. And obviously, it varies from property to property, but as a general rule of thumb, we're looking for investment properties that have an internal rate of return, a minimum internal rate of return of 15%, and then the higher the better from there. So again, this is Arion with investingarchitect.com. If you found this helpful, please subscribe to my YouTube channel, as I'm going to do a lot more walkthrough videos like this. And I appreciate you watching, and please stay safe. And I see you on the next video.